Thank you. We have a great panel here. I'm very interested in learning what they want to talk about as well. Before we start, we'll do a quick round of introductions, then we want to learn a bit more about you, and then we'll start on the main topic. So, Heslin, to you.
Hey everybody, Heslin Kim here. Been in the industry since 2015 or so, currently head of growth and ecosystem at Republic. Feel free to reach out anytime. Republic's got a global suite of full services, global crowdfunding platform, Republic OTC treasury markets, advisory services. We're running infrastructure for various projects. If you have any protocols that are interested in validator, RPC, prover, sequencers. We also have a fund that's currently raising for Fund 2, coming out likely in Q2 or so. So happy to be here.
All right, and I'm Lisa. I'm the founder and CEO of Economics Design. As the name suggests, we design economics of systems. So Web3 ecosystems, which is what we'll be talking about today, are about building economies, about building something like countries. And how do you create the rules in there is everything that we do. And so we provide a lot of consulting services to Web3 enterprises, Web2 going to Web3, and also games as well as infrastructure, DeFi, and layer 1, layer 2s.
Thank you, Heslin and Lisa. I'm Kunal. I'm a senior research analyst at Messari. I have a background in traditional finance, so I'm deeply interested in tokenomics, trying to put a valuation lens into crypto. I think we deeply need that as well. We want to do a quick vibe check of the audience here. If you're a founder, would you please raise your hand if you're a founder in the space? All right, a few founders. If you're an investor, please raise your hand. Few investors. Are you a student by any chance? Please raise your hand. All right, couple of students. And any analysts like myself? All right, I think we have a nice mixed crowd. We'll try to go over as much as we can. It's a very deeply interesting topic. And before we start, what do tokenomics mean? So Lisa, if you want to start that, what do tokenomics mean to you?
Absolutely. So I did a 4-hour workshop at Hash House 2 days ago, and it's everything I talked about. And just to distill everything very specifically, token economics, we're talking about token economics, right? Token economics is about building the economics system, building the rules of how an ecosystem works, powered by a token. A token is a means to an end that is about collaborating and coordinating distributed participants. And that could be maybe fundraising, that could be utility token, that could be governance token. It really doesn't matter. It's how do you create the rules in which these participants can participate in the rules and allow tokens to facilitate in these engagement.
Heslin, do you agree?
Yeah, I mean, Lisa here is definitely an expert on the space, on tokenomics in general. I think just TLDR, I see tokenomics as the incentivization model for engagement with your various participants who are going to be accessing and holding the token. And I've got some interesting ideas that might differ from Lisa on a application level from what I've seen. Largely around fundraising and participation from investor activity and things like that. So I'd love to hop into it.
Yeah, so I think the disagreement here is that Heslin believes tokenomics are different typically in different cycles. So whether we're in a bull cycle or a bear market, token design differs. Whereas Lisa is more of an idealist where she believes that across different cycles, you need the same kind of tokenomics. So Heslin, I'll let you start, and then so that you can't agree with Lisa here. So I'll let you start.
Thanks so much. This is going to be like a reverse David and Goliath situation because she's definitely the heavyweight in this fight. But from what I've seen to date, right, and working with a variety of very heavy range of projects raising, minimum of $1 million to upwards of $20-30 million. For me, I've seen typically it's narrative dependent, it's market driven, and it is cyclical in terms of the response that you're getting from investors on what type of activity you're going to be seeing as far as market demand. What I have noticed is that in a bull cycle, when everyone's flush with capital, there's a menial dependency on the tokenomics in the sense that if you have enough participation, if you've got enough activity, if you've got enough hype and FOMO, throwing out some Web3 terminology in there, you will be able to gravitate more investor interest without almost having any actual real design mechanisms in place. People are willing to put in capital regardless of what the tokenomics look like. They might be willing to go in for 7-year locked vesting periods, circa SBF and and Maps.me, Serum, things like this. Whereas in a bear market, you're going to be definitely heavily dependent on trying to entice investors at a very earlier stage. You could either do so through a very sophisticated, well-rounded project. You could also do so through just the hype, the focus, the community building, have a large personal engagement on your socials, on your Twitters, on your Discord. But then there are also mechanisms in place where you can manipulate those tokenomic designs to get more interest, wherein someone's not going to be willing to do a 7-year vesting period in a bear market, but if you say, hey, now we're going to be releasing TGE tokens, we're doing very quick overall vesting period, we're shortening it down to something like 3 to 6 months, we're very heavily front-loading the amount of tokens that we're going to be putting into supply. I've seen from a practical standpoint and just from an application level, when I'm going out to investors and helping with fundraising for different clients, that is a it's very dependent on the tokenomics about whether you are front-loading with TGE tokens and or an extended cliff or vesting period. And I have found it is cycle dependent on that side.
So to a certain degree, I agree with you. I think you're talking a lot about the supply side of tokens, whereas when we talk about tokenomics, it's token plus economics. Tokens is the incentive you mentioned before, right? It's about incentivization to get people to do certain things. You want them to stake, you want them to become LPs. There are a lot of incentive behaviors we want to incentivize, and tokens are a tool for that. The other part of tokenomics is economics. And we look at economics, we're looking at 2 components, the supply side and the demand side. And I agree with you, the supply side is actually very important. But the supply side is step 21 and 22. The demand side is step 1 all the way to 20. And I think we can conclude token economics on the supply side because that's the last 2 stages. But if you don't have the demand side in place, there's nothing to talk about. And why do I say this? The demand side is really dependent on your product. We talked about product market fit earlier, about the product you want to build, about the business model you want to build, about the economic agents, who are you targeting. You need to understand all these components. You need, just like building any startup, you need to have a solid business model. It doesn't need to be, everything needs to be defined, but at least you need to know where you're going. What's the vision? What's the mission? What are you building with this product? And we need to look at product market fit. Who are the users we are targeting? And tokens is part of this consideration. You don't have to build a token right now, but you have to think about them. It's not about building the business model. You build the product and you think, oh, I need a token. I need a token for fundraising. Let's think about that right now. But you've already built a lot of things in place. So how do you can't just take tokens and just sprinkle it like an ice cream sundae and sprinkles. It needs to be part of the core ingredients. And what does that mean? It means that when you look at the demand side, we need to go back to first principles. So 2 days ago, I was speaking at the 4-hour workshop, and we did a big session on supply and demand. And what does that mean? Everyone talks about economics, oh, it's just supply and demand. Yeah, you just supply and demand, and they just DCF, and then you just get the tokenomics. It doesn't work like that. If you look at the things that we can control and things we cannot control, the demand side is things we cannot control. We can understand to a certain degree, given this product that we're building, this liquidity that we're asking for, the market cycle that we're looking at, the TAM, SOM, SAM, this is the general demand that we can get. Sure, the demand could change time to time. The demand could be affected by macro markets and market conditions, but the core demand should not change. If the market demand changes so drastically because of macro market conditions, then you're just building something just for the hype. You're not building something that will last in 10 years' time. And if you're using this technology thinking, I'll just use this, I'll build this for a 2-year hype, and we do some Ponzi-nomics, get a lot of cash, and exit, that's not what we're doing with blockchain. Blockchain is here to stay, and we're building products to make sure that blockchain really flourishes the way it promises to. So the demand side is something that we cannot control, but the demand side is something that we can understand. What does demand look like? And then on the demand side, then we figure out what the supply is. If we're looking at a specific equilibrium in price and quantity, then we know roughly this is the equilibrium that will make sense. So step 1 to 20 is understanding what the demand side looks like. And then step 21 and 22 is understand, okay, given the market conditions, how do I shift my demand curve? Given a few factors, given my competitors, given opportunity cost, given substitution effects, given maybe Uniswap is running some promotion, and I'm just a new DEX coming up, how do I compete with that? And I can use my supply side to adjust. But you don't start with the supply side, and that's my point. Because a lot of people start with the supply side. A lot of people say, that, oh, I've got my tokens, I've got my vesting schedule, my pie chart, distribution, and then that's it. That's good enough. Give me the money and happy days. But my point is that it doesn't work like that. When we want to create sustainable economics, we need to start it right. We need to build it right. We build it from first principles on the demand side, and then the part that we can control is the supply side, and how do we match to get the equilibrium outcome we're looking for at that point in time.
I think that makes a lot of sense. You're specifically talking about designing the token in a way where it has sustainable demand. I have this thesis that protocols that have artificial demand for the token, they're less efficient than protocols that don't have any demand for the token, right? So if we use Uniswap as an example, the token does not play any role in the network. All the fees paid by the traders, they go to the LPs. But if you look at something like Thorchain's Rune, all the liquidity is provided against Rune, and as such, the depth of the liquidity that is on the platform is limited by the market cap of Rune itself. So it sort of limits the potential growth for the protocol. So do you believe that if we have this, if we fit the token too deeply into the ecosystem, it may trade off against capital efficiency of the protocol?
Very good question, a very good point you brought up, because what we see in Uniswap has not been really replicated in any of these later projects that come up, right? And Uniswap makes a lot of sense in this case because it was still quite a new product. It was one of the first few, it was actually the second DEX. The first DEX is actually Bangkok. They don't exist anymore, but that was one of the first ideas of how we can use the AMM kind of model and mathematical model and bonding curves to allow for decentralized trade without intermediaries and order book. So that was a very beautiful math model. That being said, because that was so new, and if we add too much complexity into the product and we add all these token components into the product, number one, the product is really very hard to use. People are all very used to order books. Now you're telling them you don't need order books. You trade with the liquidity. You trade with math. Math defines everything. Math defines the price of how much you trade. And that's so new. There's really slippage. There's impermanent loss. That's brand new, at least brand new in the crypto space. So there's a lot of nuances. There's so much to learn already. And if we add another token component to that, it limits the barrier to entry. It becomes so complicated to use and understand. And that's why it makes it, to me, I think it makes sense from that perspective, tokens come in later. But if you look at the trend of even the last just 2 years, compare the bull market and the bear market, tokens are quite integrated into the system. There are a lot of tokens that are there for hype, and we work with quite a lot of projects where they raise like 20 million, 30 million that you mentioned, but the tokens have no utility. It's like, oh, we have governance, so you just vote on the DAO and there's like utility in there. These models are all failing. And I know that because they come to ask us to redo the model and recreate a token model, to do a token swap, to reissue something that has meaning and value. Because yes, you can raise a lot of money, yes, there's all the hype, but there's no longevity. And moving forward, as projects get more sophisticated, users get more sophisticated, people understand the value that tokens can bring, I think we need to have more embedded utility in there once we have really leveled up the barrier to entry to understand how to use these protocols.
Do you agree, Heslin?
I think it's an interesting point harking back to the supply and demand perspective, because from a demand angle, I think it's, Lisa speaks from a very pure-hearted angle of the industry ethos and really sticking to the fundamentals of where we actually want to see Web3, where we want to see projects building towards utility, that the foundational use case of the token is embedded deeply in the product, and that all the participants involved are going to be wanting to use the token for those particular purposes. It's just, I hate to be the defeatist, in me is coming out on the little devil on my shoulder, but, just from market participation and, engaging in various degen types communities, which seem to be the majority of the landscape, you get this fundamental understanding that those groups are purely in it from a speculative nature. And you do see that there are very few things that entice the different demographics that really drive the long-term demand. I mean, you're going to have various participants, and I'd be interested to hear Lisa's thesis on the demographics, but I see retail, I see community, and I'll differ between those because I think retail are largely like your airdrop farmers, your social followers who are engaged on Discord, on Twitter, whereas community would be participants who are engaging in your DAOs, your forums, they're actively engaged in voting and proposals, these type of participants. You also have your investors who are your backers from the earliest stage. They're going to have a heavily vested interest in the tokenomics, the design. Also, traders, right? Your market makers and the industry participants who are going to be running with that token long term. And I think within this model, demand it really is structured differently for each participant. So weighting those typically, we've not seen, I would say, the design mechanisms in place at scale that we would all hope for. But like what Lisa's doing is pushing the industry forward definitely, because by working with credible, highly reputable companies who do have a business model, who have different mechanisms in place where you can drive the demographics into those particular token use cases, it really makes sense. A lot of projects, a lot of companies, a lot of founders start from a very early stage. They don't have this well-rounded view of how the ecosystem works. They might just be coming from a developer standpoint. So they say, we're going to do a utility token for gas. We're going to do a DAO token, and it's going to be used for governance, and that's going to be the basis of the entire tokenomics utility. I just think that where we are is so nascent in the stage of tokenomics, and the demand side for what retail investors want to see, that this is something to work towards, but in practicality and where we stand right now, it's very speculative driven, and you typically lean into tokenomic design models that only lean towards that retail participation, the trader participation, and incentivizing the investors to come in. We're missing this community piece entirely, but I think that is what goes back to first principles, and that's the real utility of what the tokenomic design should be based on.
So I have a critical point I want to add. And when we talk about sustainable economics, that's everything we're talking about so far, it changes over time. It's not something you fix, you define, you clean your hands and say, I'm off to the beach and having my cocktails. Because sustainable economics changes over time. Economic policy changes over time. As you mentioned, the market participants is what we call economic agents. Initially, you can have a lot of retail investors. And as the product builds and grows, you're going to move towards community, actual users, maybe gamers, maybe social people who are actually interacting on the platform to make friends or interact with someone else. And the market structure changes. When we talk about market participant change, it also means that the market structure changes. The demand, the frequency of transactions between certain kind of people, peer-to-peer, peer-to-smart contract, they will keep changing. So it's very important to understand that when we build the economics, we look at a time scale, right? From a 0 to 1 phase, that's all theory-based. Because we don't have any data to support anything. From a 0 to 1, we build a minimum viable economic model that makes sense based on everything that we understand. But once it goes out, once it's live, we stop doing that theory. You can't rely on theory. You've got real data, you've got real users. Nobody uses that theory anymore. When you build a product, when you first go to market, sure, you build quite a lot of things based on tests. But once your product is live, your Facebook, your Instagram, your TikTok, you look at how users are behaving, and you update the model from there. And when your market starts to tip from retail investors or from institutional investors, in 5 years' time, it becomes community, it becomes actual users, actual gamers. The economic policies, they need to change. They absolutely need to change. And we need a tool, and that's what economics design also has a tool called Aurus, and we're launching in the 1st of January. We're building a tool to help people to understand how and when to change. Because we can't just close our eyes and pick, okay, this is the time we change, and we feel that the market requires us to change. We need data to prove that, and blockchain solves the data problem. Now we need to take that data, turn it into intelligence, turn it into insights, for us to make decisions that way.
I think that's a great point as far as the upgradability, the updates alterations, and planning ahead for changes that are going to be necessary in the future. I think typically where we see things, it's very set in stone right from the beginning, but you need to take into account, if you're a founder out here, if you are fundraising, if you're creating some protocol design, that there are going to be needs for upgradability, right? When you launch, it's not just set in stone straight from the beginning. So, analytics, going over different engagements that you're seeing across all these different platforms, all these demographics are incredibly important to balancing those first principles. And I guess, this is hands off to you at Messari. Do you have any type of protocol, analytic platforms that you feel like engage that and provide founders that kind of information? Because I'm interested personally.
Yeah, I think absolutely. I think specifically for different sectors, you need different kinds of token design. So perhaps layer ones, they need to be a little more decentralized to have a bit more community buy-in. So that's why proof of work tokens worked great in the start. Ethereum as well spent a lot of time being proof of work, and that decentralizes the holdership and then the ownership of the token. And that is very useful if you're building a censorship-resistant network. I believe it's, if you're a gaming platform, it's fine to have a bit of a more concentrated ownership because there's one team that's really leading them, and their incentives need to be aligned with the goals of the protocol. So if, we've seen some projects decentralized too early, which essentially means that the founder has moved to the beach and is just sipping cocktails. So, you don't want to be, as a token holder, you want the founder to be incentivized by the token, which means having a significant amount of control over the future of the project. Just on this, I'm very glad that the investor and the idealist do agree on some things. I think upgradability is very important, and we'll see maybe as crypto matures, we'll see more protocols adopting that, more protocols and tokens adopting that. A question, do you agree that sectorally tokens should have different tokenomics? How do you view, let's say, layer one tokens, DeFi, gaming, the wide breadth that we have?
Yeah, if there's one question that people have been asking me 6 years into crypto full-time, that's that question. Is there one model that fits all token model? Is there one model that makes sense as a tokenomics default model that we should just tweak from there? And the sad truth is that there's no one model. But the good news is there's a framework for that. And going back to first principles, going back to building things from ground up, we look at three key pillars in the framework: market design, mechanism design, token design. If you think about it, market design is defining the market, this economic system that we're looking at. Who are the economic participants? What assets are there in the space? We don't have to define what kind of assets, just what types of assets are there in the space? Tradable tokens, non-tradable tokens, maybe not even tokens, just assets that we need to trade with, like real-world assets. Just describe and define what this market is. The second thing is mechanism design. And mechanism design is incentives that we both talked about. And what does incentives look like? And very specifically, incentives are rules of how people behave when you come into the market. Things that they can do and things that they cannot do. We always think of tokens as an incentive. How do I incentivize people to do this, do that, and do everything? The other thing is we also need to disincentivize people to not do something. Because yes, we have things that we can do, but we also have things that they should not be doing. How do we build in disincentivization into this model? So we have market design, mechanism design, and lastly, we finally talk about tokens. Once we can understand who is in the market, the rules of how people participate in the market, tokens are a tool to facilitate transactions in the market. And so if you think about it, it's going from macro to micro. The macro is your market. And yes, you could potentially look at substitutes, you look at benchmarking, you look at general macro market conditions and interest rates, but that's all in the macro segment. But economics is not just looking at macro market and how the world works. We need to start defining how the rules work in our economy. Why people come into the economy in the first place. What kind of rules they need to abide by when transacting. And what are the assets in the space. Tradable tokens, non-tradable tokens, fungible tokens, non-fungible tokens, reputation tokens, SOBAL tokens. It really doesn't matter. What we're describing here is the value that's being generated in the ecosystem and trading. And whether we sell them or not, whether they have part utility, they're part of liquidity, they're part of taxation you need to pay, different kind of spreads, it's a secondary problem. But we need to start with describing what assets are there in the space, and then we can start engineering them.
Heslin, a quick response because we're running out of time.
It's hard to disagree with what Lisa said. I think, it's really, actually, can you ask that specific question one more time?
Yeah, so do you believe that in different sectors,
Yeah.
tokens should have like different designs, or
Oh, yeah, right. You know, exactly what Lisa said. It's not a one size fits all, right? You're not going to apply the same sort of tokenomic design to a security token as you would to a utility token for a DeFi platform for NFTs. I mean, there's no way to get around that, right? So when you go about this, it's kind of like my TLDR Eli 5 explanation of tokenomic design. It's really about incentive mechanisms and knowing the demographic that you're going to be catering to. I think Lisa explained it succinctly on that side. But really, from a I think a broader level, it really does boil down to some pragmatic steps to launching a project, and it is first principles. It's a business model that has some sort of revenue-generating opportunities, and it is understanding these steps in place that you're going to need to know all of the various participants that are going to be engaging to know what type of tokenomic design model to end up with, right? So, I think as a whole, the industry has a long way to go before there could be set standards and templates for all these different mechanisms, which we could get to that place in the future, but it is going to be based off analytics, the benchmarking, and past successes of companies who are at the forefront of these leading designs that we're seeing now. And I would avidly support companies who are trying new models, who are testing out new things, and who are trying to create new mechanisms for incentives for these various users across this entire economy. Because what we're seeing now across this landscape is just a various cookie-cutter cloned model, right? We're seeing just the same thing over and over. So really taking a step outside, focusing on this, and trying to implement something new, be innovative. Tokenomics can be innovative across the board, and I think that would be my final say here.
yeah, but like super helpful. Before we call it, I won't do my job as like an analyst unless I hear one ticker or like a few tickers that you guys specifically think have implemented good sustainable tokenomics, because that's what I'm really truly interested in. So whoever wants to go first, give us like a few tickers that you specifically, I think, have done a great implementation of tokenomic design.
So I'll go first, and I think let's talk about, because we got different industries, right? There's no one size fitting all. Let's talk about games. Avalanche is sponsoring this. The biggest game on Avalanche is Shrapnel. Shrapnel is very interesting as a first-person shooter extractive game. I think the game is coming out like somewhere next year. When it comes to the DeFi side of things, I really don't have not investment advice. Just I really enjoy Nexus Mutual, and to me, tokens is a signal of preferences, is a signal to express some form of value. And I can go on and on about how Nexus Mutual is being designed. I think the math is very elegant and very beautiful. Things I do not like: friend tag, Ponzi scam with extra steps.
Yeah, from my side, really quickly wrapping up, I think MakerDAO has done an incredible job across the space providing that community aspect of the demographic that I was speaking about. They really have driven things to a level of sophistication that almost no other project, I think, has. And they've also got the longevity and duration and backing from massive community members who are trying to move forward with new innovative models and figuring out what works and what doesn't. And they've done a great job of innovating and making changes when necessary. And then going back to something as simple as Bitcoin, right? If you have a proven utility and you are going to stick to that use case, keeping it simple, keeping it straight to the point, not adding a lot of additional superfluous things to it, right? Kleros is also another one that's very interesting that Vitalik represents and supports quite heavily as far as jury weighting and things along that nature. So those are some very interesting, outside Bitcoin, everyone knows, but those are some interesting cohesive communities that I think have made landmark steps towards driving new, innovative tokenomic designs.
To know my picks, you'll have to subscribe to Messari Enterprise. But I'll thank our panelists. Thank you for dropping this much alpha, this much knowledge on us. Please give a big round of applause for both of them.
Thank you.
Thank you so much, Kunal. Thank you, Lisa. Thank you, Hazy.